On Friday, the 21st of August, 2026, the Straits Times Index closed at 5,688.96. 6 sessions earlier, on Thursday the 13th, it had closed at 5,720.05. Do the subtraction, down 0.54%, and the explanation printed that week in wire copy and headlines was that Singapore was sliding because Wall Street's technology trade was sliding. Here is my claim: across those 6 sessions, the Straits Times Index did not fall, it paid out. 3 companies went ex-dividend inside that window: DBS Group Holdings, Overseas Chinese Banking Corporation, and United Overseas Bank. Together, they are 56.69% of the index. Between them, they removed at least 0.72 percentage points from the index level in 2 trading days, not because anything became worth less, but because cash left the companies and turned up in shareholders' bank accounts, and a price index does not follow it there. Put that back and the index finished the stretch higher, not lower. This is not a story about Singapore beating America. It is a story about a measurement. The Straits Times Index yields 4.33% and pays it in a handful of large installments. The S&P 500 yields 1.10% and drips it out 4 times a year across 500 companies. Compare their percentage moves across a Singapore dividend week, and you are not comparing 2 markets. You are comparing 2 numbers, one of which has a hole in it. I will show you the filings, the arithmetic, and the opening prices that prove the arithmetic is right. Then I will show you exactly where this correction stops working, because there is a version of that same week in which Singapore genuinely did fall, and I am not going to hide it from you. None of this is investment advice, it is accounting. Chapter 1: What the tape printed. Start with the numbers and start with the timestamps, because a market figure without a date attached is worse than no figure at all. Singapore first. Every level here is the close of a completed session on the Singapore Exchange, which shuts at 5 in the afternoon local time. Thursday, the 13th of August, 2026, 5,720.05. Friday, the 14th, 5,743.59, up 0.41%. Monday, the 17th, 5,768.46, up another 0.43% and the highest close of the month. Then it turns. Tuesday the 18th, 5,701.40, down 1.16%. Wednesday the 19th, 5,694.24. Thursday the 20th, 5,671.91. Friday the 21st, 5,688.96, up 0.30%. 13th to 21st, close to close, minus 0.54%. Now America, over the identical calendar window. Every figure is the official close of a completed session, 1600 hours New York time, and Friday the 21st is complete because it ended at 4 in the morning Singapore time on the day I am recording this. The Dow Jones Industrial Average, minus 1.05%. The S&P 500, minus 1.60. The Nasdaq Composite, minus 2.32. The Nasdaq 100, minus 2.58. And the Philadelphia Semiconductor Index, the narrowest and most exposed of them, minus 5.75%. So on the face of it, a clean story. American technology sold off hard, everything else sold off less, and Singapore sold off least of all, but still sold off, because that is what happens when Wall Street sneezes. Friday itself was the strangest session of the 5. The Dow rose 517.80 points, 0.98%. The S&P and the Nasdaq Composite each rose 0.43. The Semiconductor Index fell 0.51, having been up 1.22% at its high and down 1.43 at its low. Hold that whole picture in your head. It is entirely accurate, every number in it is real, and the conclusion most people drew from it is still wrong, for a reason that has nothing to do with any of these markets, and everything to do with 3 announcements filed on the 6th and 7th of August. Chapter 2: 3 filings, 2 days. On the 6th and 7th of August, 2026, Singapore's 3 big banks reported their half-year results and declared their dividends. These are not summaries of announcements. These are the announcements filed to the exchange, and I pulled all 3 off the Singapore Exchange's own document server. DBS Group Holdings first. The board declared, and I am quoting, an interim 1-tier tax-exempt dividend of 66 cents for each ordinary share for the second quarter of 2026, and a one-tier tax-exempt capital return dividend of 15 cents for each ordinary share, 81 cents in total. The estimated dividend payable, in the bank's own words, is 2,302 million Singapore dollars. And then the sentence that matters most to this video. Quote, the DBS ordinary shares will be quoted ex-dividend on the 14th of August 2026 Friday, end quote, the company itself naming the day. Overseas Chinese Banking Corporation filed the 7th of August, an interim tax-exempt dividend of 47 cents per ordinary share against 41 cents a year earlier. The payout, the bank says, amounts to an estimated 2.11 billion Singapore dollars, roughly 50% of group net profit of 4.19 billion for the first half. And quote, the record date is the 18th of August 2026. United Overseas Bank, same day. An interim one-tier tax-exempt dividend of 88 cents per ordinary share against 85 cents a year earlier, paid in cash on the 28th of August. The transfer books close from 5 in the afternoon on the 18th of August, and entitlements are computed, quote, based on the shareholdings position after settlement of all trades on the 18th of August. Neither Overseas Chinese Banking nor United Overseas Bank printed the words ex-dividend in those filings. They gave a record date. So I took the convention from DBS, which gave both. In April this year, DBS was quoted ex-dividend on Wednesday the 8th and closed its books from 5 in the afternoon on Thursday the 9th. In August, it went ex on Friday the 14th and closed its books from 5 in the afternoon on Monday the 17th. Ex-date, then record date 1 business day later both times. Run that backwards from a record date of the 18th and you get an ex-date of the 17th. So the calendar is this. DBS trades without its dividend from Friday the 14th. Overseas Chinese Banking and United Overseas Bank both trade without theirs from Monday the 17th. 2 consecutive trading days. 3 of the largest listed companies in Singapore, 81 cents, 47 cents, 88 cents. Now hold those 3 filings next to the index chart from the last chapter. The 14th and the 17th are 2 of only 3 sessions in that whole stretch when the Straits Times Index rose, and they are the 2 largest. And I am about to argue that they rose considerably more than the tape says. Chapter 3, 56.69%. The arithmetic here is not complicated, and that is exactly why it gets skipped. When a company goes ex-dividend, its shares open worth less by roughly the dividend because the buyer no longer gets the cash. In a price index, an index that tracks share prices and nothing else, that drop passes straight through to the index level. No adjustment. The index simply prints lower and the reason is not in the number. So the damage a dividend does to an index level is 1 multiplication. Take the company's weight in the index. Multiply by the dividend as a fraction of the share price the day before it went ex. FTSE Russell publishes the Straits Times Index and its fact sheet. The edition dated the 31st of July 2026 gives the weights. DBS 28.69%, Overseas Chinese Banking 17.99%, United Overseas Bank 10.01%, 3 companies 56.69% of an index of 30. Now the prices from the close before each ex-date. DBS closed at $76.35 on the 13th of August. Take just the ordinary 66 cents and leave the capital return out. I will come back to why, and that is 0.86% of the share price, multiplied by a 28.69% weight, 0.25 percentage points off the index. Overseas Chinese Banking closed at $31.79 on the 14th. 47 cents is 1.48% of that, times a weight of 17.99, 0.27 percentage points. United Overseas Bank closed at $41.80. 88 cents is 2.11% times 10.01, 0.21 percentage points. Add them, 0.72 percentage points, taken out of the Straits Times Index across 2 sessions, of which 0.48 lands on Monday the 17th alone. That is the conservative version. DBS's 15-cent capital return dividend may or may not be treated as an ordinary dividend by the index. FTSE Russell's own corporate actions guide says a distribution the company calls special is treated as special, but that if it recurs on more than 3 consecutive occasions, the 4th is treated as ordinary. DBS's own results announcement for the 4th quarter of 2025 records capital return dividends of 45 cents across the first 3 quarters of that year, plus 15 cents for the 4 consecutive quarters, and it has paid it again in the 1st and 2nd quarters of 2026. That is 6 consecutive occasions, well past the 4th. On that reading it counts as ordinary, and the total is 0.78 rather than 0.72. I am going to use the smaller number throughout. It is the one I can defend without resolving the classification, and as you are about to see, it is already enough. Chapter 4: The Opening Gaps. Arithmetic is one thing. I want to show you the correction sitting in the actual prices, because if the dividends really did what I say they did, the tape has to show it at the opening bell. DBS, Thursday the 13th of August it closed at $76.35. On Friday the 14th, the first day without the dividend, it opened at $75.60. That is a gap of 75 cents against a declared dividend of 81. Overseas Chinese banking. Friday the 14th closed $31.79. Monday the 17th opened $31.05, 74 cents lower against a 47-cent dividend. United Overseas Bank. Friday close $41.80. Monday open $41 flat, 80 cents lower against an 88-cent dividend. 3 stocks, 2 mornings, all 3 opening sharply lower on days when nothing had been announced. 2 of them gapped by slightly less than the dividend. Overseas Chinese banking gapped by more, 74 cents against 47, so some of its opening weakness was genuine selling, and I am not going to pretend otherwise. But the order of magnitude is unmistakable, and it is not sentiment. It is bookkeeping arriving on schedule. Now run the day properly. Take each bank's close-to-close move on its ex-date and add the dividend back because the shareholder got it. DBS printed minus 1.07% on the 14th. Its ordinary dividend alone was 0.86% of the previous close. Adjusted for that, DBS was down 0.21% instead of down 1.07%. Count the 15-cent capital return as well and it was flat, down 0.01%. Overseas Chinese banking printed minus 0.76% on the 17th. Its dividend was 1.48%. Adjusted, it rose 0.72%. United Overseas Bank printed minus 1.60%. Its dividend was 2.11%. Adjusted, it rose 0.50%. Every one of the 3 had a better day than the tape said. 2 of them had a good day recorded as a bad one. And so did the index. The Straits Times Index printed plus 0.41% on the 14th of August. Corrected, it was up 0.66. It printed plus 0.43 on Monday the 17th. Corrected, it was up 0.91, more than double. Which brings us back to where we started. 13th of August to 21st of August, the index printed minus 0.54%. Add back the 0.72 percentage points of dividend, chaining the daily returns properly, and the same 6 sessions come out at plus 0.18%. Use the larger reading of DBS's capital return, and it is plus 0.23. The sign flips either way. Singapore's index did not go down over that stretch. It went up and handed out cash on the way. Chapter 5: 4.33 against 1.10. At this point, the reasonable objection is that all price indices leak dividends. The S&P 500 is a price index, the Nasdaq Composite is a price index, the Dow is a price index, so why single out Singapore? Because the size is not remotely comparable, and neither is the timing. FTSE Russell's factsheet, dated the 31st of July, 2026, puts the Straits Times Index dividend yield at 4.33%. State Street Global Advisors runs the oldest exchange-traded fund tracking the S&P 500, and its own fund page for that product gives the index dividend yield as 1.10% as of the 20th of August, 2026, with distributions paid quarterly. The fund's 30-day yield is quoted at 0.94% on the same date. 4.33 against 1.10. Singapore's index yields close to 4 times as much. Now the timing, which matters more than the level. Spread 4.33% evenly across about 250 trading sessions, and you get 0.017 percentage points of dividend leaking out of the index on an average day. It is invisible. Nobody adjusts for it, and nobody should. But the 0.72 percentage points that came out on the 14th and 17th of August is not an average day. It is roughly 42 sessions worth of dividend, arriving in 2. Run the same calculation on the S&P 500. 1.10% across 250 sessions is under 0.005 percentage points a day. 2 days of that is under 0.01. Singapore's 2-day dividend drag was on the order of 80 times larger. The cause is structural and it is specific. 56.69% of the Straits Times Index is 3 banks. Overseas Chinese Banking and United Overseas Bank both pay semi-annually, both reported on the 7th of August and both went ex on the same Monday. DBS pays quarterly but went ex the trading day before. There is no equivalent event in an American index, because no 3 American companies are half of one, and because 500 companies paying quarterly on 500 different calendars smooth each other out by construction. So the honest comparison is not Singapore minus 0.54 against the S&P minus 1.60. It is Singapore plus 0.18 against the S&P minus 1.57 once you take both indices' dividends into account. The gap between those two framings is nearly 3/4 of a percentage point, and it is not market movement. It is 3 checks. Chapter 6: What this does not explain. Now the part where I argue against myself, because a correction that only ever works in one direction is not a correction, it is a preference. The dividend adjustment is entirely dependent on which day you start counting from. That is not a subtlety, it is the whole thing. Start on Monday the 17th of August after all 3 banks had gone ex, and there is no adjustment to make because there is no ex date inside the window. Over those 4 sessions, the Straits Times Index went from 5,768.46 to 5,688.96, minus 1.38%. Real, unadjusted, and worse than the Dow's minus 0.34 over the very same 4 sessions. So if the claim you heard was that Singapore fell that week, and the week you meant was Monday to Friday, that claim is correct and my correction does nothing to it. Singapore fell, and it fell harder than the Dow did. Tuesday the 18th is the clearest case. The index dropped 1.16% that day, its worst of the stretch, and none of that came from these 3 banks. All 3 were already trading ex. Whatever happened on the 18th of August in Singapore was a real repricing, and this video does not explain it. 3 more limits worth stating plainly. First, and this one cuts against me, not for me, I counted 3 companies. The Straits Times Index has 30, and I did not go through the dividend calendar of the other 27. So 0.72 is a floor for those 2 sessions, not a total, and the true figure may be larger. Second, I reconstructed this adjustment from company filings and published index weights. I did not take it from a total return index published by FTSE Russell because I could not obtain one. That means my 0.72 is a calculation, not a quotation. I believe it is right, the opening gaps support it, but it is mine and not the index administrators. Third, the weights I used are dated the 31st of July, 2 weeks before the ex dates. Weights drift with prices. In this case, Overseas Chinese Banking outperformed the index over those 2 weeks, and United Overseas Bank underperformed it, and recomputing with drifted weights moves the total by less than 1/100 of a percentage point. But that is a check I did afterwards, not a guarantee built in. What survives all of that is narrow and I think solid. Over any window that contains the 14th and 17th of August, the Straits Times Index's printed return understates what a Singapore shareholder actually received by about 3/4 of a percentage point. Over windows that do not contain those days, it does not. Which means the sentence Singapore fell last week was true or false in August 2026 depending entirely on which Friday you started from. Not on what happened, on where you put the ruler. Chapter 7: What would change my mind? I want to be specific about how this argument dies, because a claim that cannot be killed is not worth making. 1. If FTSE Russell applied a divisor adjustment to any of these 3 distributions, treating them as capital repayments rather than ordinary dividends, then the index never took that hit and my number is too big. The live case is DBS's 15 cents. I have already stripped it out of the headline figure for that reason. The 66 cent, 47 cent, and 88 cent ordinary dividends are not in serious doubt. Those are exactly what a price index is built to ignore. But if someone shows me an index adjustment applied to one of them, the number moves and I will move with it. 2. If the X dates are wrong, the 2-day split is wrong. DBS named its own X date in its filing so that one is settled. Overseas Chinese Banking and United Overseas Bank both gave a record date of the 18th of August, and I inferred the 17th from it. If both actually went X on the 18th, then Monday's correction moves to Tuesday, Roughly 2/5 of Tuesday's 1.16% fall becomes mechanical, and the total across the window is unchanged. That would make the story stronger, not weaker, which is a good reason to be suspicious of my own preference for it. 3. The clean kill. Somebody with a terminal can pull the Straits Times Index total return series for the 13th and the 21st of August, 2026, and compare it to the price series. If the gap is not somewhere near 0.7 of a point, I am wrong and it takes one line to prove it. I would genuinely like to see that number. What would not change my mind is being told that the Straits Times Index still fell over the week. It did on the Monday to Friday framing, and I said so in the last chapter. Here is the general lesson, and it is the reason I made this. A price index is a partial measurement. For the S&P 500, the missing part is about 1% a year, arriving in a steady drip, and you can safely forget it exists. For the Straits Times Index, the missing part is 4.33% a year, arriving in a few lumps, and forgetting it exists will make you misread a fortnight. Two markets, two different quantities, quoted in the same unit and compared as if they were the same thing. Every figure in this video is dated, and everyone comes from an exchange filing, an index fact sheet, or an official closing print. None of it is a recommendation, a target, or a view on what anything is worth. I have told you what the numbers are and where the ruler goes. What you conclude from that is your business.